Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Art Group Holdings Limited interim report. Art Group Holdings Limited offers a range of services and businesses that cater to the needs of various industries in China. The company provides operation and management services for shopping malls and industrial parks, which suggests its expertise in property management and facility maintenance. In addition to these core services, Art Group Holdings also engages in rental activities, indicating that it owns or manages properties that are leased out to tenants. This diversification into rental income generation highlights the company's ability to adapt to changing market conditions and expand its revenue streams. Overall, Art Group Holdings Limited's business operations encompass property management, facility maintenance, and rental services, making it a significant player in China's real estate sector. The stock price of Art Group Holdings, 565, has experienced a significant surge in the past year, with a reported change of up to 65.63%. However, despite this substantial gain, it is unclear what specific events or developments have caused this increase. Recent financial announcements from February 2026 indicate that the company expects to report a significant unaudited consolidated net loss for the 6 months ending December 31, 2025. This would typically lead to a decrease in stock price rather than an increase. A closer examination of the available information reveals no clear explanation for the substantial rise in Art Group Holdings' stock price over the past year. The company's financial performance has not been particularly strong, and recent announcements suggest that it may be facing significant challenges. As such, it is difficult to pinpoint a specific cause for the increase in stock price. Art Group Holdings Limited maintains a market capitalization of $5 billion, broadly in line with the industry peer group. Art Group Holdings Limited trades at a higher price-to-earnings ratio of 102 times and a higher price-to-book ratio of 156.92 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 101% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified through a review of the key factors that have impacted the company's financial performance. Revenue growth is primarily driven by leasing activities. The leasing of Zone C shopping mall to various tenants has contributed significantly to revenue growth, as has rental income from leasing properties in Jian City and Zhengzhou, Yinghao, and Yinghan. These leasing activities have provided a stable source of income for the company. On the other hand, several factors have led to a decline in revenue. The most significant contributor to this decline is the discontinuation of cargo aircraft charter segment, which resulted in a loss of revenue. Additionally, the absence of one-off gains on lease termination, deferred tax liabilities, and bargain purchase has also impacted revenue negatively. Furthermore, decreases in property management fee income and rental income from leasing properties have also contributed to the decline in revenue. The discontinued operations have also had a significant impact, with revenue declining from HK $42,268 in 2024 to $0 in 2025. The net income of the company underwent significant fluctuations between 2023 and 2024. Initially, it decreased by 18.8%, indicating a decline in profitability. However, this trend was reversed in 2025 when the net income increased by 5% from the previous year. This change suggests that the company was able to recover from its losses and improve its financial performance. The profit margins of the company also experienced a significant downturn. the margin decreased due to various reasons, including operational inefficiencies and market challenges. Specifically, the profit margin dropped from 29.8% in 2024 to a loss margin of 167.7% in 2025. This drastic decline indicates that the company struggled to maintain its profitability during this period. Despite these setbacks, there are indications that the company is taking steps to improve its financial performance. The expected increase in profit margins due to exploration of new market potentials and cost control measures suggests a positive outlook for the future. By leveraging new opportunities and optimizing costs, the company may be able to restore its profitability and achieve sustainable growth. The company's financial performance indicates a consistent trend of negative operating cash flows. The extracted summaries reveal that the company has experienced significant net cash outflows from operating activities, resulting in substantial losses. In 2025, the operating cash flow was reported to be negative $13,419,000, while in 2024 it was negative $12,111,000. Furthermore, page 15 of the summary highlights a net cash outflow of $1 million in 2025, reinforcing the notion that the company is struggling with generating positive operating cash flow. Overall, these findings suggest that the company's current financial situation does not indicate a positive operating cash flow. The company's interest expenses and debt levels have undergone significant changes over the past few years. Although there is no data available for previous periods, the interest expenses for 30 June 2025 were reported at $24,347, which is a notable increase from the unaudited figure of $10,488 for 31 December 2025. This suggests that the company's interest expenses have increased significantly in recent times. In terms of debt levels, the net current liabilities decreased from $103,396,000 to $93,074,000, indicating a reduction in the company's debt obligations. This decrease in debt level is a positive development for the company, suggesting that it has made progress in managing its financial obligations. There is no notable activity in terms of acquisitions or divestitures. The company has not made any significant purchases or sales of assets, businesses, or subsidiaries that would be worth mentioning. This suggests a stable and consistent approach to business operations, with no major changes in the company's portfolio or structure. The company's financial strategy has been focused on growth and expansion rather than distributing profits to shareholders. As a result, the company has chosen not to pay dividends to its investors. Additionally, it has also refrained from buying back any of its outstanding shares, instead opting to reinvest in the business to drive future growth and development. That concludes the financial summary for Art Group Holdings Limited. Feel free to comment below, and I will be happy to answer them when possible.